Absolutely. The Saudi announcement was the shock heard around the world, right? After 3 years of cooperation amongst OPEC and their peers, now it's 3 days worth and it all goes to naught. All right, so now you've seen a lot of floating storage demand pick up on Monday when crude prices fell 25%. That means the front month went down to $33, $34 for a barrel of Brent. Whereas 3 months from now, 6 months from now, it's maybe $36, $37, $38 a barrel. So that $3, $4 spread is enough for traders to step in, buy the front month, sell it 3 months, 6 months from now, and all they need is a ship to store it. So that's what pushed rates from 30, 35,000 a day for one of these VLCCs. That's a very large crude carrier that holds 2 million barrels of oil, from 35,000 last week to 50,000 a day on Monday. And then yesterday, Saudi thought, well, if we're going to produce 13 million barrels a day next month, we need a way to move it, right? So they went on a chartering spree. They locked in over 20 VLCCs to move these incremental barrels from the Middle East to the United States, through the Red Sea, and a lot into Asia. So that pushed rates from 50,000 a day on Monday to current levels of $165,000 a day. This is the highest surge we've seen since the Costco sanctions went into effect back in October of 2019. So certainly a frenetic chartering environment here with all these incremental Saudi barrels that no one expected to hit the water.
Randy, hey, thank you so much for joining us. This is Julia. You cover such an interesting space, and you do such a thorough job covering it. You just did a great analysis there. Help our viewers understand what they can take away from watching the tanker space that you cover so closely.
Absolutely, yeah. Well, what you saw in January through March is what we normally see, right? Rates went down from 100,000 a day down to that 30, 35,000 a day level I just mentioned. And a lot of that is seasonality, right? As you get through the winter season, as you get into the refinery maintenance season, a lot of these importing nations need less barrels of oil. Now, with Chinese New Year, that kind of exacerbates. With coronavirus and Sinopec shutting its refinery in China, all these independent teapots shutting their refineries, now you need maybe 2 million barrels a day less than you needed a few weeks prior. So with that, tanker rates fell dramatically. But now we're starting to see Asia come back to the market, right? The Sinopec refineries starting back up. Some of these independent teapot refineries starting back up. So it's a good macro view for saying, all right, Asia is starting to improve now. Obviously, coronavirus is spreading more globally now, but the biggest consumer in the world, or the biggest importer at least, China, they're starting to come back to the market. So when you see that inflection point, they need the barrels to come in before they refine it, and then the jet fuel, the diesel, the gasoline that gets refined starts going out. So it's a good macro kind of leading indicator for what's going on in Asia and globally, right? With these low crude prices, $30, $35 a barrel, you'll certainly see some inventory building, kind of what we saw in 2014 to 2016, because a lot of it doesn't really have a place to go in terms of demand right now with coronavirus and kind of slowing global trade and economic activity. Now, when that reverts and when that rebounds, is it 2 months from now, is it 4 months from now, is it 6 months from now? Who exactly knows? But there will certainly be a spike in demand for these refined products. So the refineries are starting to position themselves by increasing their crude inventories.
And Randy, how does this factor into your outlook on the space for the rest of the year?
Yeah, absolutely. Every year, as I said, in that kind of seasonality that happens, January through pretty much August is kind of a straight line down and to the right. Then August through December, it ramps up dramatically. So we expected rate softness in the second quarter, and then maybe further rate softness in the third before a market rebound in the fourth quarter. That said, you're seeing rates, like I said, 165,000 a day, much higher than our 30, maybe 40,000 a day estimates for the second quarter and third quarter. And what you're seeing this week, $150,000, $165,000 a day. These voyages take 40 to 90 days to move that oil, right? So what's being fixed today is going to last you into April, into May, possibly even into June, depending on the voyage duration. So we are much more bullish now on the tanker markets, and that's what you saw yesterday. Some of these tankers had the single best day in the history of them trading on a public market. You look at TK Tankers, you look at Frontline, you look at Euronav, International Seaways, some of these VLCC-owned operators that have a lot of crude tanker open operating days, those are starting to rip. Now, a lot of them were shorted in February. Now you're starting to see those shorts being squeezed out, and you're seeing incremental demand because energy investors, instead of playing maybe U.S. domestic producers that are likely going to get squeezed from this incremental barrels coming out of Saudi, now the UAE, now Russia, if they're looking for a way to play the volumes, that is the pipelines of the sea, right? That is the shipping. That is the tanker companies. So now our estimates are certainly looking a little conservative, to say the least, currently relative to where they were a week ago for the next 2 or 3 months, if not 2 or 3 quarters.